Hey guys, how's everyone doing? So on this screen here, I'm doing some projections for the consumer price index for all urban consumer CPIs. And then I have another screen with Telegram and all the filings and everything. I got some other that I'm doing here, some stocks, calculating cash, debt, EV, price, stock. Why is this like this? I don't want this like this. Okay. So yeah, it was a pretty busy day. But full of good things. And then on my other screen, I have the Telegram. As I've mentioned, I have my Edgar sort of terminal, as I can call it, I don't know. And then I got some filings. I got some, this is Coca-Cola, KO, financial files, look into some assets, liabilities, and equities, and so on. This is a drug company, JetBlue, Chipotle. Chipotle is something that I'm looking at very, very, oh wow. That's very equilibrated. Look at that. Employees by gender. Male got 49.3, female 49.3, and older 1.4%. I don't know what the older means, but yeah. Where is this? They don't have it. That's interesting because I was trying to find. I was in shorts yesterday in GBPLG. Beautiful trade. Good one, good one, good one. Shareholders equities. Oh, that's interesting. But that's not what I want. I want the balance sheet of this. I want to see the cash, financial statement, and supplementary data. That's the one I want. This is balance sheet. There we go. So cash and cash equivalents, they have more. Oh, they don't. They have 560,000 only. Oh, that's not good. Well, they still got more than 2022, but that's not much. 8 million bucks only. Anyways, people are joining. For those who are not familiar with these, this is basically every company listed is a public company, right? You do have private companies like this one that I've just showing you. This one, EURUSD Pharmaceuticals Inc. They are a drug company, private, hold it, since September 22, 2017. Sorry, not since then. No. 4.1 million penalty to settle the charge at occasion 2017. Don't know when they found it, but anyways. So you go to SEC, right? That's the Security Exchange from USA. You go to company filings, and then you can search for the ticket of the let's say give me some company, public listed company. Show me some company here. Let's search them. Okay, I'm gonna pick one then. Let's go FMG. Okay. Here. So once you have it, you can actually see everything, right? You have the company filings, you have the mailing address, the state of corporation, business address, notice of sale. So if I click here, it's going to open me document that I can read through and go through all those papers here. So this is pretty much what I was doing before we start and trying to predict CPI tonight. Anyways, we do got some nice numbers here. I think it's time to start then. What else should I do? Yeah, that's all. Oh, and then on my other screen, I have some other stuffs happening as well. But okay, let's go for it. So as I've mentioned, guys, today is going to be a little bit different. I'm going to try to use trading view in one screen and try to use the FinLogics on the other screen here. So I can show you. I'm going to try to put both together, right? But so then I can show you the economic calendar on FinLogics, and you guys can, do the exactly same as I'm doing on your computer. That's not a problem. So first of all, let's pick one currency pair here. I think euro dollar would be the most traded currency, Forex pair, sorry, that most of you trade, probably from gold, from all the commodities. Maybe euro dollar is the most traded instrument. So I'm gonna pick euro dollar for us. Let me just reload it. And then what I will try to do is I will try to divide my screen in two and then get this one here. Oops, am I back? Yes, I'm back. What I will try, where is it? Can't see it. FinLogics. Anyways, I'm just gonna open another one. Let me close this. Let me close this. I'm gonna open this. This one comes to here. And then I pick this one. Cool. So go to FinLogics. And then we go to economic calendar. So for those who don't know what are we doing today, we are back testing some fundamental strategy. All right. So how this fundamental actually gets triggered into the price. So anyways, so let's select a date. All right. I was trying to think what date could we take from and how could we do this. But my most sincerely opinion from you guys would be we take 2023 in a whole, right? So we take from January 2023 to now. But then that would take much more than 1 hour. So what I will do is I will get from the half of 2023, so June, July, all the way to now. So we still got like 9 months. Well, actually 8 months, all right? But with those 8 months, we got plenty of data, all right? And most importantly, I would like to make some points here, right? Last year was a very different year for the Forex market, as of central bank was having much more influence on the market than the actual data. Okay, so for that, we will need to go back to some of the FOMC statement and as well as the ECB statement, monetary statement, policies, monetary statement. Because as we trading euro dollar, okay, if you're trading other currency like USDJPY, you would go and search for FOMC statements and Bank of Japan statements. Even though it was pretty easy to trade USDJPY last year because we only had up moves, from 2023, there we go, all the way from actual January to December, we only had up moves. Sorry, until November, we only had up moves. And then all of the sudden, you know, from October and November, actually, sorry, we did had some little tweaks happening on the bodge, but Bank of Japan, but that's not what we're talking today. So I have my euro dollar chart open here. Let's get from June. June. Here we go. All right. Yeah, that's good. Okay. I see some new names here. That's good. Let me see who's new. Never seen Julian da Costa. Welcome. I think I've seen you before, but can't remember that. Zodwa, not too sure, but welcome. Saad, fake Portuguese. Yeah, I remember you. I remember you. What else? Yeah, I think that's all. Okay, can you guys see both of the screens? Can you guys see the trading view and the FinLogics? I think you all can, right? March, April, May, June. No. Ooh, that's not good. What am I? Oh no, I'm sharing. I'm sharing the wrong screen. Let me share again. Oh, there we go. Now you can. Good. Okay. So on the one side, we have TradingView, and another side, we have the FinLogics. So if you want, you can do the exactly same as me. Or if you have two screens, you can put FinLogics in one and TradingView in another, just because I can't share two screens at the same time. And if I could, that would be very stretched on YouTube as well. So people, you know, willing to watch the replay won't be too happy about that. So I've selected a date here from June on euro dollar all the way to now. Okay, so we're going to start on June here on 1st of June 2023 all the way to now, if we have time, actually, because that's a lot of things that as I've stated, right? Because we had a lot of central banks as well. I'm even going to open already here ECB just here, and the Fed as well, so we can be able to come and read those reports. And then on the FinLogic side, I will select 1st of June all the way to the date that we are now, year to date here, 12th of March. And then we will select only euro dollar. So click on the little earth here, little globe, and then select. You're most probably going to have like this. I'm just going to take it off all, you know, take it off all of the select all, and then just choose Euro, just choose United States and Euro area. And on the impact news, I will take it off the low impact. I will take it off the medium impact and only leave the high impact. Okay. So on the European Central Bank, I understand and I accept. Go. What we're going to search is on Google, we're going to go ECB monetary rate statement, click enter, and then this one, the first link, and we're going to be on here on this page. Okay, so if you click on press release just on the top here, yes, by date, and there we have it. June. Here, 1st of June. And then on the Fed, we're going to do the exactly same thing. Fed is much better because you just select 2023 and you come to June. We didn't have June, so we had July. So that's fine. Oh, here, June. Right. So that's pretty much all we're going to need. If you want to take notes, you know, you can have a notepad aside. Maybe you prefer to take notes on your hand, or if you want to take notes on the computer, it's up to you. You can have a Word document or something like that. I'm going to be using TradingView for today because it's going to be easier for us to use these curl out here that we can just push and add what just happened. Okay. So first of all, let's have a look on the economic calendar. What is happening? What was happening? This is 2023. Okay. If you guys have any questions, please just you know, don't be afraid of interrupting me. Just send me a question on the chat, and I will be looking to this later. So United States jobs job openings from April came much higher than the expected. So this is positive for the US dollar. Okay, but after that at 7, we did this at midnight, and then at 7 p.m. we had a euro area unemployment rate that came as expected. Okay, so if it comes as expected, if some news comes as expected, oh no, oh gosh, there you go. If some news comes as expected, then this is priced in on the chart already. So what does that mean? Well, it basically means, let me just select all here again. So it basically means that it won't have any huge impact on the actual chart. Okay, so what can we go here and add most importantly? Well, we can see that the euro area unemployment rate was as expected, but the euro inflation rate year over year flash, that's the flash, that's not the actual, that's the flash, May was 6.1%, and the forecast was 6.3%. So that means that we had a 0.2% lower than expected. For the economy, for the population, this is fantastically good, right? Why? Because then food prices will go lower, energy prices will go lower, you know, consumption will go higher, and so on. So your money will actually be worth what is actually worth. That, you know, tricky there, but your money will be worth more in a sense. But for the currency, this is not good. Why? Because investors would like to opt for countries where have high inflations, where they can wait for the central bank to raise or to maintain higher for longer. Okay, so in this scenario right now, we didn't have a very good take on the euro. Okay, so from here on Thursday, so from here to, oopsie, sorry, from here to here, pretty much these 3 candles here, we had a lower inflation euro as expected, unemployment euro, and higher US jobs opening. Okay, so this is pretty much how we started here. So with a stronger euro leading up this move. But one thing that I want you guys to pay attention here, right? It's not something that will happen now that will shape a huge move. It's bit by bit, we go increasing those data that goes in favor of one country and unfavor of another country, and we have a move, right? So we're gonna go, what does flash mean? I'm gonna get that in a second. Just let me finish to explain this. So when we have a accumulation of data for one country or another, then one of the events will trigger or maybe a rates decision, maybe a monetary policy statement, maybe a speech from someone, then this will go on the side where, you know, all the market were predicting. Now, what does a flash mean? So we have different types of inflation release. We have core, we have flash, we have actual inflation. A flash estimate is an early, pretty much estimate. So it's before the actual inflation, and it just comes maybe, you know, a week or 2 weeks before the actual, and it just shows what the market, what the numbers are showing on that moment. So it's just a flash. So basically it's an estimate of, it's a variable. It's very variable, okay? That would be what is a flash. So it's something very quick that they show, but they're not sure. And then after that, we have the actual data. Now, on Friday, 2nd of June, ISM manufacturing PMI, as well as NFP, as well as the United States unemployment rate come lower. Now, one thing here that triggered this move here, okay? One thing that we can already see that triggered, where is my pen? Oh, here. Okay. One thing that I can show to you, that triggered this move here was this. Okay, this seems like a good data, all right, because we had a higher NFP. We had like 190, and then it came 339,000. Okay, so pretty much, let's say pretty much the double. All right, let's work as pretty much the double. That's 1.2, 1.3 more than expected, times 1.3 times more than expected. But what, as I always say on my YouTube videos and everything, that we need all of the three data. I don't have the second data here, but it would be the average hourly earnings to be on the good side or either on the bad side for us to have a big movement. But with this huge move to the upside on the unemployment, because look at that, we were expecting 3.5% and it came at 3.7%. So more people got unemployed, right? So here we go. United States unemployment rate. Okay. I don't know why it says May here, but that should be Jan. So, and then the ISM manufacturing PMI came at 46.9, and it was expected to be 47. Even though it was 1 point lower than expected, it was negative. And this number here, it did have an influence on the market for a bit. But then those two numbers here, they lead the market going up. Okay. So let's note it down, all of these just here. So what day was that? That was Friday, 2nd of June. Friday, 2nd of June. There we go. We had it here. The previous month. Oh yeah, true. I'm sorry. We're looking at sorry. We're looking at June. I thought we were looking at January. Here it was bad ISM and bad unemployment. So bad manufacturing and bad unemployed. No. And then we start on Monday, nothing. Tuesday comes the United States ISM Services PMI as expected. Well, 0.1 more, lower than expected. 52.2 was the consensus. It came at 50.3%. So that's pretty bad for the US. So we do have on Tuesday, there we go here as well. So bad services, ISM. I'm just going to do bad services. Bad services PMI. Okay, it's good. Bad services PMI on here. And there we have the Euro rally. Okay. This is not much important. Balance of trade. Inflation rate. Okay. This is where the things starts to picking up on Tuesday, 3rd of June. Tuesday, 13th of June. There we go. Here. See that from all of those three news combined here, dollar was somewhat weaker, but the euro wasn't that strong, all right, because we only had a lower inflation and an as expected unemployment rate. Even though we had an as expected unemployment rate, the US dollar, the USA, have had a lower unemployment rate, so that's not good. So compare it to the US dollar strength and the euro strength. It's not because the euro was stronger, but it's because the US dollar was much weaker than the euro at that point of time. Okay, so on the day 13th of June, here, 13th of June, oopsie, sorry, this one, 13th of June, we had a lower inflation year over year, month over month, and an as expected core inflation on US. So that's pretty bad for US. Remember what I've just said. And this is not the flash. This is the actual inflation numbers. Okay, so bad inflation. Sorry, not bad. Let's say lower inflation for USA. Okay, and there we go with a move to the upside on the euro dollar. So all of those four news combined in here in a couple of days, started to make this move here. All right, when is the next new? 14th of June. So this move here was occasionated. What's that? Let me check. This is from here to there. This is 100 pips. Okay, this is not bad. This is not a bad trade. Now, 14th of June, we had the PPI month over month, lower than expected as well. And that was much lower than expected. That was Wednesday, 14th of June. So there we go. Another move to the upside on here. Okay, this move here. We don't need to point that out, but I'm just going to point it here. Better PPI as well. And then on Thursday, we had a few things here, very good for the US, but most importantly, we have the euro area ECB interest rate decision, deposit facility, and the most important, the press conference. Okay, so there we go. So Thursday, 15th of June. Thursday, 15th of June. 15th of June. There we go. Monetary policy decisions. We're going to read through it pretty quick. I know it's, lots and lots of things, but I think we most probably would be looking to read through these first paragraphs here. Inflation has been coming down, but it's projected to remain too high for too long. Okay, too high for too long. That's something that we need to notice already. What does that mean? Well, if the next inflation data, the market is expecting to be lower, we already know that the central bank is expecting to be higher for longer. Okay. Some miracle would have to happen to actually inflation come down or whatever. So the Governing Council is determined to ensure that inflation returns to its 2% medium-term target in a timely manner. It therefore today decided to raise the tricky ECB interest rates by 25 basis points. Well, there we have it. We already know the reason. Why did that happen? Because they raised 25 basis points. Okay, 15th of June 2023. When we go here, 15th of June 2023. Okay, so this move was occasionated by ECB raises rate by 25 BPs. Now, the important thing here is, okay, they've raised the rate. All right. How are they expressing it? Are they being hawkish? Are they being dovish? Or are they being a forced hawkish? What do I mean by that? Did they raise the rate because they need it? Because they can? Or they sort of raise the rates, you know, because of tensions or something like that? Well, this is exactly what we're going to be looking at now. The rate increase today reflects the Governing Council's updated statement of the inflation outlook. Well, there we have it. We have the answer ready. They raise the rates because they're looking for a higher inflation, as they just stated, to remain high for too long, and therefore they raise the interest rates already to accumulate a higher interest rates for longer. Therefore, the inflation that will maintain it for longer will come on a slowly decrease. The dynamics of underlying inflation and the strength of monetary policy transmissions, according to the June macroeconomic projections, Eurosystem staff expect headline inflation to average 5.4% in 2023. Okay, let's do something here. Let's do a notepad. And we're gonna note it down. Can you guys see the notepad? You can, right? I think so. So staff expected headline inflation 5.4 in 2023, 3% 2024. There we go. This is what we need. Copy. I'm gonna paste it here. So let's leave it for later. All right. Indicators of underlying price pressures remain strong, although somehow tentative signs of softening. So that's okay. Staff have revised up their projections for inflation, excluding energy and food, especially for this year and next year. Okay. So this is actually, when we look to the core of the this line here, is basically that they've raised it. That was a pretty simple raise. They raise it because they need. All right. So there's those three questions: because they need, because they can, or because they want. Because they need. That's it. Because they need. Otherwise, inflation would go too high, and they wouldn't be able to control already on the pace. So I don't want to prolong myself. Otherwise, we want to have time to, see the other moves. But this is why we had already this move. Okay, cool. Everyone understanding? Everyone cool? I think so, right? Let me just drink a bit of water. Okay. It was hard, but that's the problem, man. Let's have a look. Let's have a look. Again, it's just because the unemployment rate was much higher than the actual figure on what they were expecting. So, think with me. Rather you have people getting employed and then a week later they get unemployed, or you want slowly people getting employed and keeping with their jobs for longer, all right, for 5-10 years, or you want like quick in, quick out. So that's not good, right? So this is literally not good. And this is why we had an opposite of the move, what the people was expecting to have on the euro dollar to go down. No, they actually went up. Why? Because the unemployment rate was much higher. Now, we stopped on Thursday 15, so that's here. All right. So ECB raises rate by 25 basis points, widely expected. This is nothing to do with the 25 basis points. It's to do with what we just read it. Okay. United States, Michigan consumer sentiment, that's all right. United States building permits, that's okay. Tuesday 20. Thursday, nothing. United States durable. Oh, that was just speeches. We can't go back to it, unfortunately. Okay, Friday, 3rd of June. So see what happened when there is speeches. All right. See what happened when there's speeches on the market. Nothing happens. It just goes sideways. Why? See, we had like different people speaking. So we had Powell and then we had Powell again. Oh, sorry. Let me go up. There we go. We had Powell testimony, and then we had EURUSD forum, and then we had President Lagarde. Then we had a forum again where most of the chairs speak. And then we have President Lagarde, and then we had Powell, and then we had Powell again, Powell, and then another forum, and then so on. Okay, so imagine all of those people, they have different ideas. All right, one have a hawkish idea, one have a dovish idea, one have a bullish, one have a bearish, one wants to project high, one wants to project low, one don't want to project, one don't want to go. So there's so much things happening that the market simply don't, besides it is as actually very hard announcement of something like we're going to raise rates next week. That's it. And then the market will feel it, all right? And then all of them saying the same thing. That's going to be very interesting to see, but that's most probably never going to happen. And so this is what happened with the market, pretty much nothing. It stays sideways. All right. So now until when? Until Thursday, 6th of July. Okay, let's have a look on what we got here. Durable goods. No. Okay, unemployment rate came as expected. Inflation rate, that was 30 of June. 30 of June. Okay. Inflation rate year over year from June last year, 2022, to June 2023. Let's see what they say. 5.4%. What the market was expecting, 5.6. What I say, that the central bank was looking to project inflation average 5.4%, even though the consensus was at 5.6, we would be looking to expect something lower. And what did it come? 5.5. It was lower than expected. Okay, so the central bank was right. Anyways, moving ahead, we had personal income of a month raising. That's good. Personal spending decreasing. So people were saving on the month of May. ISM manufacturing. There we go. Tuesday, 4th of July. Okay, so let me do something with this. Let me grab this, and I will drag from the meter, and I will put speeches equals consolidation. Okay, and then on 4th of July, we had manufacturing PMI. 4th of July, we had PMI lower, USA. Okay. Expected was 47. We came at 46, so lower than expected. And then we had on Thursday, 6th of July, United States FOMC minutes. That's going to be interesting. So let's go for the Fed now. 6th of July. 6th of July. The minutes are here. Released on July 5. That's USA data date. So for me, it was 6. So let's go HML. Okay, so one thing I want to do here, because it's the minutes, it's too long, right? It's very, very long. What you guys can do is you can definitely, go through all of these, but we can use the technology into our favor. So what I'd like to do is, I get this guy here. And I will provide you the minutes from the FOMC, and I want you to give me the best dot points, summarize it. And I'm going to use the most important parts in dot points, summarize it. Click enter. Go here, copy all of the text. You don't need to copy the name of the people present on the day, because that doesn't matter to us. We just copy all of these texts. We don't need this. Well, you can put all of these together, but that's going to be, I don't know if ChatGPT will be able to read, or is it too much? Yeah, the text is too big. So we can divide it in two. So we can take half of this, say here. Okay. Copy, new chat, paste, come back here. Where is this? Oh, that's a big one. Okay, cool. Now we come here and we take half of it from the beginning. Somewhere here. Let's see. All right, let they do the work. Okay. So let's have a look on here. So developments on the financial market and open market operations. Policy sensitive rates increase, reflecting economic resilience, elevated core inflation, and reduced downside risks post debt limit resolution. So that's something, okay? Debt limit. Remember in 2023 where the Fed actually took it off the debt limit? That was the debt ceiling. There was lots of things happening on that time. A few banks crashed yet, SVB, Credit Suisse, and I forgot the other one. But for helping the bank, they need to provide liquidity. The central bank is the last lender. It's the lender of the last resort. That means that they need to provide liquidity, money, cash, for the banks. Otherwise, they wouldn't survive. Policy expectation shift contributed to higher treasury yields, with real rates driving the increase more than inflation compensation. Broader equity prices rose, but outperformance was considerably improved. Investor sentiment towards regional banks. That's good. Financial conditions indexes were roughly unchanged. And anyways, you go through all of this. Staff review of the economic situation is, I think, the most important. So let's have a look on this. Real GDP expanding modestly in the second quarter with tight labor market conditions. Okay. Robust job gains, low unemployment rate, and elevated consumer price inflation. Nominal wage growth is slightly lower, but still elevated. So that's good. Foreign economic growth rebounded in the first quarter, but indicators suggest a step down in the second quarter. Market participants perceived a more resilience in economic activity than expected. Treasury yields, broader equity prices increased, and borrowing costs increased. And what are the outlook? Forecasted a mild recession later in the year due to expected further tightening in bank credit conditions. Real GDP projected to decelerate in the current and next quarters, with growth below potential output in 2024 and 2025. So what can we expect for 2024 already? We're expecting USA slowing the growth. All right, next GDP must be probably slowing. Unemployment rate forecasted increase this year, peak next year, and remain near that level through 2025. Unemployment rate. Okay. This is not secret. This is like all on fat. It's just normal. What just happened last week? We had a much higher NFP, but we have a huge unemployment number. Voila. Magic. No, it was here. They've said it already last year that they are expecting to increase the unemployment rate on last year, that's 2023, peak of this year in 2024, and remain near that level through 2025. So think about it. Inflation forecast little revised, with risks tilted to the upside, reflecting continuing strength in labor market conditions and the possibility to persistent inflation. Right. This is all we need from them. So this is pretty much bad for the US dollar. Okay. So on the FOMC minutes on Thursday, 6th of July, that was here, it was pretty bad for the US. All right. They revised it. They revised the numbers down. They revised the growth of the country down. They revised inflation up, little bit up, right? No investments, and this is really bad, right? So what we're gonna say is FOMC minutes bad. That's all. Okay, and services PMI higher than expected. Jobs opening May lower. Non-farm payroll much lower. Unemployment rate as expected. Inflation rate lower. Inflation rate year over year lower. Core inflation rate lower. Core inflation rate month over month lower as well. This was on 12th of July. So I don't need to say anything, all right? I already explained it. I don't want to go through everything again. Really, really bad for the US dollar. So until 7 and 12. So all the way to here, this whole move here, okay. Short squeeze, it's different. Short squeeze doesn't happen like this. These moves have been done because all of the accumulation of bad data for US and much, but well, yeah, not good data from Europe, but you know, a very weaker dollar, I would say, because the COT was crowded at this time in mid-July. Yes, but the COT, it's not as you guys may be thinking. Okay, COT is much longer term. COT can be for years. Therefore, COT can be as well hedging. Okay, so it's very complicated to read the COT in a very precise way. So this is why I just do this as much efficient, I would say. Anyways, so all of the data from US was really bad. That stands for inflation, NFP, jobs opening. What else? That was pretty much it. Okay. What I want you now to pay attention. This. So from here to here was all of these bad data from US. Okay. We did had a euro area inflation rate flash again from 5.6 to 5.5. Unemployment rate came as expected. So that's not bad. That's not bad. As expected. As expected is not bad. It's just as expected. All right. All right. Retail sales came much lower on 18th of July as well. Where is 18th of July? 18th of July here. US lower retail sales. Okay. Okay. We only have 8 more minutes, but I think you guys got the sense on how we do these. Do you guys have any questions regarding? I'm going to go through everything again. No questions? Wow. Some smart people here. It's good. Right. So, just going through everything again. It's not one actual data that will make the market move in certain direction. It may be when it's very, very strong to one side or very, very strong to another side. But typically, it doesn't happen like that. The way it happens is building up pressure to one side and building liquidity, let's call it like this, as you guys most probably know and have heard on YouTube and so on. It's not the right term, but building a way to the market actually go through. So on this up move here, you could be catching 538 points. So 5,381 points to basically 538 pips. So that's pretty good, right? So I encourage you to do the exactly same thing on your charts now and send me on the Telegram. What I mean by that is come here since the beginning of this year, all right? Since here, maybe no, that's 2 liter. Since no, that's all right. Since beginning of this year, end of 2023, so December 2023 to now, and show me a picture. Tell me what just happened, and you will understand where the market is going for. All right, I can't guarantee you that, but like I'm pretty sure you will be understanding where the market will go in the next couple months. US election, I can talk about that. We just don't have time today. I can do a video on YouTube tomorrow. It gave me an idea. So wait for the video tomorrow and I can do that for you. I'm gonna note it down actually. US election video YouTube tomorrow. Tomorrow is what day? 13. Okay, cool. All right, guys. Are you really born in 2001? Yes, I am born in 2001. How do you know that? You guys have any more questions before I go? So that's the way you backtest a fundamental strategy. And of course, we haven't done it, but there's all of these move here, and then there's all of these move, and then there's all of these move, and now this move here. All right. So I encourage you to do this. I encourage you to do this. And of course, I haven't mentioned, but you can put some lines here. You can do some trend lines, and I don't know what do you guys trade, but you can start to put trend lines and see what matches and what not. Okay, guys. Tomorrow this will be on YouTube. All right, I will share the link on the Telegram channel, so you guys can have a look on everything again, and go through step by step on how I do it and how I figure out to do this all. Okay, hope everyone enjoyed today, and hope to see everyone back on Thursday, where we're gonna go through CPIs and everything that happened during the week on Thursday. All right, guys. Thanks all. Have a great week ahead, and I see you on Thursday. Bye-bye. Thank you.